Welcome back. In this financial literacy video, we're going to discuss loans, specifically understanding interest rates, what interest is, the difference between fixed and variable rates, and the difference between simple and compound interest. In another video, we'll talk about some of the nuances of different types of loans, including car loans and student loans. Okay, so let's talk about the definition of a loan and how they work. So, from a previous video, we talked about loans being a type of credit, in particular, installment credit. And the reason it's considered installment credit is because, unlike a credit card, in a loan, you get a lump sum of money that is borrowed for a specific purpose. Typically, you can get cash loans, but usually loans are used for a specific purpose like buying a house, buying a car, or going to college, for examples. And when you borrow that lump sum of money, there is a set of conditions for paying that money back that's going to include interest. These loans can come from banks, from lending companies, and it may even be possible that you would have a private loan, maybe from a friend or a family member, that would include a contract with interest repaid to the lender. So when you take out a loan, you have to pay back that lump sum plus interest. When you're taking out a loan, you really want to minimize the amount that you have to take out and not take out more because you don't want to have to pay extra interest on money that you didn't need. Typically, you will slowly repay that loan back each month, a portion of which will include your principal and your interest. We'll talk a little bit more about that in a moment. And then if you are getting a loan from either a bank or a lending company, you have to get qualified for that loan. And part of that qualification is going to include looking at your income and your debts and your credit score, as we discussed in a previous video. Those things will determine both your interest rate as well as how much you'll qualify for that lump sum for that loan. So, a little bit of the basics of interest. There's two terms I'd like to introduce you to. One is an interest rate, and the other is principal, because when you pay back every month a little bit of that loan, you're going to be paying the principal as well as the interest rate. So, interest rate is the amount you pay for the privilege of borrowing money, and it's calculated as a percentage of the principal. The principal is the amount that you borrowed. So, in the example below on this graph here, maybe you had to borrow in principal $300,000 to pay for a house that you purchased. The interest rate is going to be 5% of that $300,000 that you borrowed, and you're going to pay it off a little bit every month over the course of 30 years. We'll talk about amortization in a moment, but what I want you to see here is that you are paying both the amount that you borrowed as well as a percentage of that borrowed money, which we're calling interest. So, types of interest. There are fixed and variable rates. These are the two kind of common concepts here. Fixed variable or a fixed rate means that the current interest rate at the time that the loan was taken out is what you will be paying on each month. So if it's 5%, every month you're always going to pay 5% of what you borrowed. If it's variable, that means that the interest rate could change monthly based on current rate trends that are set outside of our control. So we hear in the news about interest rates going up, interest rates going down. However they're changing, your interest rate could change every month. So that's important to note because if you take out a loan while interest rates are low, you might think, great, it's only 3%. I can pay that. But if you have a variable interest rate on your loan and loans go up, that means that you might not know how much you owe the next month or the next year because the interest rate could change. And if it goes up on you, that could be very difficult for you to budget for. So if you're ever in a situation where you are looking at taking out a variable interest rate loan, be really cautious about that because the rates could go up more than you think, especially if it's over a very long-term loan, like a 30-year mortgage on a house. Interest rates are definitely going to change quite a bit during that time. Um, I would encourage you to pause the video for a second and just go to another tab and Google fixed and variable interest rates on mortgages right now. See what they're at. Are they at 5%? Are they at 10% or 7? Are they at 15? Just take a look. All right. And then the last concept I want to introduce to you here is the difference between simple and compound interest. This is a mathematical concept that we could learn the formula for, but for our purposes here, I just want you to understand the concept more so than know how to do the math. So, simple interest is where the interest that you are paying back on your loan is earned only on the principal. So this is like, if you look at the graph here, you'll see that over time, maybe over 20 years, it looks like, you borrowed $1,000 that's getting paid back. That's the blue principal section here. That's the amount of the loan. Now, the interest that's simple is in this orangey color here in the middle, interest not compounding. This just means you were paying, say, 5% of the principal every month. Now, that's different from compound interest because in compound interest, the interest earned is both on the principal and all of the previously accrued interest. So you'll notice here that you end up paying quite a bit more, substantially more than double interest if you're using compound interest than you do if you have interest that's not compounding. It's quite common to use compounding interest, particularly on loans like home loans. Simple interest is not as common, but our minds might automatically think we're getting simple interest if we don't know what compound interest is. So this is another reason to be really cautious about how much you take out on a loan and only taking as much as you need, because look, you only borrowed a very small amount here, only that $1,000, but you're going to pay $7,500, six of which is going to be in interest if you're using compound interest or your loan has a compound interest stipulation. So that's an important distinction to make, and to see that if you're paying more in interest, and that would even be true in a simple interest case, you'd still be paying more interest than you would on your principal. That those are reasons why we should be really cautious about when we use loans and how much we take out. They can be unavoidable for really big purchases like cars, student loans, or buying a house, but it's not something we should take lightly. All right, I'll see you next time.